You may have heard of a 1031 exchange and how it is beneficial, but do you actually know which taxes are being deferred while doing an exchange? Hello everyone, I'm Ryan Stolman, President of US 1031 Exchange Services, and today we're tackling a vital aspect of 1031 exchanges, tax implications. So first up, let's be clear on what we mean by tax deferral. I cannot emphasize enough that a 1031 exchange only defers taxes rather than eliminating them entirely. This is an important distinction and it's significant for your investment planning. So next up, let's look at the primary reason investors utilize a 1031 exchange. The primary reason investors utilize 1031 exchanges are to defer capital gains tax. This tax is calculated and typically falls within the range of 15 to 20% of the profit from the property sale. Then the next tax that gets deferred is depreciation recapture. Another huge benefit is the deferred depreciation recapture tax. These depreciation deductions are taken over the useful life of the property and are recaptured and taxed at a higher rate, usually 25% upon the sale. The next tax that we are going to take a look at is the net investment income tax. This is also known as the Medicare or Obamacare tax, which is imposed on certain investment income for taxpayers with income above specific thresholds. This is also an additional 3.8% tax for those who surpass a certain threshold. And getting to look at the next tax, we take a look at state taxes. Considering the implications of state taxes on your 1031 exchange is something you cannot overlook. The state may impose their own capital gains taxes or recapture provisions, which could ultimately affect your overall tax liability. And last but not least, you cannot forget about estate taxes. While not directly related to 1031 exchanges, it is important to understand the estate tax implications of deferring capital gains through a 1031 exchange. One thing to consider is how your heirs may benefit from a stepped-up basis, potentially reducing or eliminating capital gains tax liability upon the inheritance. An important note, it's extremely important for you to consult your CPA or tax advisor throughout this process to ensure you're staying within compliance and to optimize your tax strategy. So in summary, navigating the tax landscape for 1031 exchanges requires careful consideration of capital gains tax, depreciation recapture tax, any net investment income tax, any state income tax, as well as any estate tax. Consulting with your CPA or tax advisor is essential before making any decisions. So when you're ready to explore your 1031 exchange options, please make sure to give us a call today. I'm Ryan Stolman with US 1031 Exchange Services, and until our next video.